Risk, return, and correlation, the data. Hey everyone, welcome back. Here's a question I hear constantly. Should I invest in stocks, bonds, or real estate? And the honest answer most people get is either a vague "it depends" or a confident recommendation driven by whoever's telling them. Today we're going to answer it with data. Not opinions. Not anecdotes. Actual long-run return figures, risk measurements, and the correlation data that tells you how these asset classes move relative to each other. This isn't just about picking one over another. Understanding the mechanics of return across asset classes is the foundation for understanding why diversification works, why portfolio construction matters, and why the 60/40 portfolio became a global standard, and what its 2022 failure tells us about its limits. Numbers will come up. I'll explain each one as we go. Let's build the framework. Before we compare asset classes, we need to be precise about what we're measuring. Return in investing refers to the percentage gain on an investment over a period, the annual return on a stock portfolio, a bond fund, a property. The critical distinction is between nominal return, the raw percentage gain, and real return, which adjusts for inflation. A 7% nominal return in a 3% inflation environment produces only 4% of real purchasing power growth. Real return is what actually makes you wealthier. Risk in finance is formally measured as standard deviation, a statistical measure of how much returns vary around their average. If a portfolio has an average annual return of 8% and a standard deviation of 15%, roughly two-thirds of annual returns will fall between -7% and +23%. A higher standard deviation means a wider range of outcomes, more volatile, more uncertain. The intuition. Return is what you expect to earn on average. Risk is how bumpy the ride to that average will be. A high return, high-risk asset is like a plane to your destination, fast, but turbulent. A low return, low-risk asset is like a train, slow and steady, but you'll get there without white-knuckling the armrests. The foundational principle of finance is that higher expected returns require accepting higher risk. There is no free lunch, no asset that delivers high returns with low variability on a sustained basis. What you can do, through diversification, is reduce risk without giving up return, and that's where correlation comes in. Here is how the major asset classes have performed over the long run, based primarily on U.S. market data spanning the last century or more. These are approximate figures, the exact numbers vary by time period and data source, but the relationships between them are robust. Several things jump out from this data. First and most importantly, equities have delivered the highest long-run real returns by a wide margin. Roughly 7 to 8% annually in real terms, sustained over a century. The compounding effect of this is staggering. At 7% real, a dollar invested doubles approximately every 10 years. $1 becomes 2, then 4, then 8, then 16. Over 30 years, a single dollar becomes approximately $8 in real purchasing power. Second, that return comes with the highest risk. A standard deviation of 15 to 17% means that in any given year, you might earn 25% or lose 10%, and the distribution is wider than that in extreme years. The maximum drawdown figure, a 57% peak-to-trough decline during the 2008 to 2009 financial crisis, is not a theoretical worst case. It happened. An investor who put their entire retirement savings into the S&P 500 in 2007 saw it cut in half before recovering. Third, bonds deliver stability at the cost of return. Real returns of 1 to 3% are modest. But the lower standard deviation, roughly 5 to 7%, means far less volatility. And crucially, government bonds have historically tended to rise when equities fall, providing a portfolio cushion. The exception, which we'll discuss, is the 2022 environment, where rates rose rapidly and bonds fell alongside stocks. Fourth, gold's real long-run return is near zero. Gold does not pay interest or dividends. Its price appreciation over long periods roughly tracks inflation, meaning it preserves purchasing power rather than generating wealth. Its value in a portfolio is as crisis insurance and inflation hedge, not as a return-generating engine. Fifth, real estate, when accessed through REITs, offers stock-like returns with stock-like, or higher, volatility, plus income from rents. Physical real estate adds the complications of illiquidity, leverage, management, and local market dynamics, factors that can amplify both gains and losses beyond what the index data captures. Return and risk are important, but correlation is the concept that makes modern portfolio construction possible. It's also the most misunderstood concept in personal finance. Correlation measures how closely two assets move together, expressed as a number between -1 and +1. A correlation of +1 means two assets move in perfect lockstep. When one rises 5%, so does the other. A correlation of -1 means they move in perfect opposition. When one rises 5%, the other falls 5%. 0 means no relationship. Here is the mathematical insight that earns Harry Markowitz his Nobel Prize in economics. When you combine assets whose correlation is less than 1, even if they're not negatively correlated, just not perfectly in sync, the portfolio's risk is lower than the weighted average of the individual assets' risks. This is the free lunch of diversification. You can reduce volatility without proportionally reducing expected return, simply by combining assets that don't move together. Practical example. Suppose equities and bonds have a correlation of 0. When equities fall 20% in a bad year, bonds might be flat or slightly positive. A portfolio that's half equities and half bonds doesn't fall 20%, it falls something closer to 8 or 10%. Your return is lower in the good years, but the devastating loss is also cushioned. For investors who can't psychologically or financially survive a 50% drawdown, this matters enormously. The critical caveat. Correlations are not stable. The stock-bond correlation that underpinned conventional wisdom, roughly -0.3 to -0.5 through most of the 2000s and 2010s, broke down in 2022. When inflation drove both rates higher and growth expectations lower simultaneously, equities and bonds fell together. The diversification benefit that 40 years of data had suggested was reliable, wasn't. This is why understanding why assets are correlated, not just what the historical correlation number is, matters more than the number alone. The most famous application of correlation theory in investing is the 60-40 portfolio. 60% equities, 40% government bonds. For decades, this has been the default allocation for institutional investors, pension funds, target-date retirement funds, and sophisticated private investors around the world. The logic is straightforward. Equities provide the long-run return engine. Bonds provide the stabilizer, rising when equities fall, providing liquidity during drawdowns, generating income. The negative or near-zero correlation between stocks and bonds meant that a 60-40 portfolio experienced meaningfully lower volatility than an all-equity portfolio, with only a modest reduction in return. From 1990 to 2021, a U.S. 60-40 portfolio returned roughly 9 to 10% annually with significantly lower maximum drawdowns than 100% equity. 2022 broke this relationship. The 60-40 portfolio lost approximately 16 to 17%, one of its worst years in history. The mechanism was the one we discussed. Rapid rate hikes hit both equity valuations and existing bond prices simultaneously. The correlation that had been negative or near zero flipped to substantially positive. The structural reason this happened. The negative stock-bond correlation of the post-1990 era depended on a specific macro environment, inflation below 3%, and the expectation that the Fed would cut rates in a recession. When inflation runs at 8 to 9% and the Fed is raising rates to fight it, the dynamic inverts. In that environment, both stocks and bonds are repriced lower as the discount rate rises. The 2022 experience generated serious debate about whether 60-40 is a permanent framework or a regime-dependent one. Alternatives gaining attention include broader diversification into real assets, commodities, infrastructure, TIPS, alternative risk premia, and private market exposures, though each comes with its own complications around liquidity, fees, and access. Everything we've discussed so far is primarily based on U.S. market data. For investors outside the U.S., and for U.S. investors who want to understand international diversification, there's an additional layer of risk. Country concentration. Japan provides the most instructive case study in financial history. In December 1989, the Nikkei 225 peaked at nearly 39,000. Over the following decade, it fell approximately 80%. In February 2024, more than 30 years later, the Nikkei finally surpassed its 1989 peak for the first time. A Japanese investor who invested exclusively in domestic equities at the peak in 1989 experienced 3+ decades of zero or negative real returns. This wasn't because Japan was a poorly managed economy with weak institutions. Japan had, and has, world-class companies, strong rule of law, sophisticated financial markets, and a highly educated workforce. The problem was valuation. The 1989 Nikkei was priced at price-to-earnings ratios of 60 to 70 times. When valuations that extreme correct, the recovery takes decades, even if the underlying economy performs reasonably well. The lesson is not avoid Japan, it's that any single country represents idiosyncratic risks that global diversification eliminates. The US itself could theoretically face a Japan-style scenario if its equity valuations became extreme enough. Concentration in any one country, including one's own, is a risk that doesn't need to be taken. For non-US investors, the practical implication is explicit. Exposure to global equity markets, particularly through low-cost index funds tracking the MSCI World or similar benchmarks, eliminates the country concentration risk that has been the single largest source of long-run return dispersion across different national investors over the past century. For currency effects, holding foreign assets introduces currency risk, but over long periods, currency fluctuations tend to be a second-order concern relative to the equity return differential. A Japanese investor who held global equities through the 2022 yen depreciation actually saw outsized returns in yen terms, as the weak yen amplified foreign equity returns. Over decades, the equity return dominates the currency effect. Let's bring this together into the principles that matter most. First, unexpected returns. Over long horizons, equities have delivered the highest real returns of any liquid asset class, approximately 7 to 8% annually in the US. Bonds offer roughly 1 to 3%. Real estate, accessible through REITs, offers returns comparable to equities with similar or higher volatility. Cash barely keeps pace with inflation. Second, on risk. The return premium from equities comes with genuine risk. Maximum drawdowns of 50 to 60% are not theoretical tail events, they're historical facts that have occurred multiple times. Any investor who cannot emotionally or financially tolerate a 50% temporary decline should not hold 100% equities, regardless of their theoretical long-run optimality. Third, on correlation and diversification. Combining assets whose correlation is less than 1 reduces portfolio volatility without proportionally reducing expected return. This is the closest thing to a free lunch in finance. But correlations are not stable. The 2022 stock-bond correlation breakdown is a warning that historical correlations are regime-dependent, not laws of nature. Fourth, on country diversification. The Japanese experience over 35 years is the clearest possible illustration of why concentration in any single country's equity market is a risk without compensating return. Global diversification is not just theoretically appealing, it's empirically validated across a century of data. The implication for personal investing. A globally diversified, low-cost portfolio, across equity regions, with some bond allocation calibrated to your actual risk tolerance, has historically been the most reliable path to long-run wealth accumulation for the vast majority of individual investors. Thanks for watching. If this series has been useful, a subscribe and like makes a real difference. See you next time. Thank you so much for watching until the end. If you have any questions or comments, feel free to leave them below. We're also looking for topics you'd like us to cover next, so let us know. Don't forget to subscribe and hit the like button if you enjoyed this video. Don't miss the next episode. Subscribe to the channel and hit the bell.